Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today we're going to be analyzing Tyson Foods stock. This one came in by request down in the comments section of one of my other videos. If you have a stock you would like me to analyze on the channel, just drop it down in the comments section. I'll get the ticker on the whiteboard behind me and I will eventually make a video. Usually I only post stocks that are in the S&P 500 for free on the YouTube channel, and the rest I post on Patreon, which is $5 a month. And if you join there, you can get a big discount to my full Cyclical Investors Club service over on Seeking Alpha. Those links are in the description. In the case of Tyson Foods, I don't think it's in the S&P 500, but I think there's a lot of value, at least some valuable lessons to be learned here. And it will show a little humility on my part because I lost money on it. And it gives me a chance to kind of talk about some broader principles that I think are important that have kind of taken place in the market, and then just analyzing stocks in general. So it gives me some things to talk about that I think are worth talking about. As always, this isn't individual investing advice. This is just how I analyze stocks. In this case, how I lost money. So Tyson. First thing I usually check is the historical earnings. Now, this did have a kind of a spike down here in 2006, way back then. So you can see that there is some cyclicality here, but it was at an unusual time. And so I kind of took this as maybe just a one-off. When I shrunk, and they were profitable during the Great Recession. I mean, it wasn't great, but it wasn't horrible. So I kind of gave them the benefit of the doubt because I had a lot of cash left over after the 2020, in 2021, basically. I was actually, once the vaccines came out in late 2020, going into 2021, I was very bullish on the economy, which turned out to be exactly correct. A lot of people were not bullish on the economy. So that call was correct. And I had a lot of cash, so I was looking to get it into the market. Unfortunately, the market was very expensive. I expected there to be inflation, and cash yielded nothing. So there was quite a bit of pressure to find a place to put cash. So in a normal situation, maybe I would have looked back here, and I would have said, it looks pretty cyclical. It might be a little bit dangerous during a recession. But I did know that what the industry was. There has been consolidation since then. They definitely had pricing power during the pandemic and even into the later stages of the pandemic. So it looked like we were on the tail end of that, and that could potentially continue. But this is definitely a situation where it would be an edge case in a judgment call because earnings fell a lot. Even if you wrote that this year off as a one-off, the trend was down here until it bottomed and then bounced back and went from there. So a little bit weird here. It wouldn't be like my first choice, highest quality investment. But when you have a lot of cash left that's about ready to lose 20% due to inflation, you tend to be a little bit more lenient when it comes to things, and that's what I did. So I don't think I was totally unjustified looking for some border cases that I thought were relatively safe in late 2021. So let's look at the actual results. So I bought it in November of 2021. And I lost 37% when I sold it a year and a half later. Okay, so that's how that went down. Now, I'll get into that more in just a second. But what I was looking at then was earnings spiked up, and I thought that they were going to be fine for this next year and then going on after that, and they were. So they actually went. I mean, at one point, the stock was up. More importantly, earnings were up, right? And the stock was up 20% in short order. And the valuation looked pretty decent here. It was 9 times. So it could have some cyclicality like it had had in the past and still not really be very expensive. Now the 85% earnings drop is more than it experienced, except for that time period way back in the day. So that was more than expected, but it was reasonable to think, if you have to put money to work, maybe not such a bad spot. And if they could keep their pricing power, they should do just fine. So that was the thinking there. So where did it go wrong? I think there were a couple places that it went wrong. One, the pricing power wasn't there once stimulus ran out. So the boom bust of the stimulus, I hadn't really fully identified by that time. Right around that is about when I noticed something was going on. And it was, I think I started writing about it the next month in December. So we were right on the edge of where I hadn't really realized this boom bust risk, which I was really early in identifying it. By early 2022, I was actively selling things that I thought could be hurt by this boom bust, and we weren't buying things that looked like they could bust. But Tyson wasn't one of the ones that I thought was going to be, even though they had this big earnings jump. If you looked at the longer trend of earnings growth, if you took out these couple years, it could have easily, gone up there. So it didn't really seem like super risky in that regard at the time. And so that was kind of my thinking at the time. The valuation looked okay. Now, the main place, other than obviously an 85% drop in earnings, which wasn't expected, and there are other stocks like this too that I managed to avoid. So we'll look at a couple of those that I wrote about. I made a video on advanced auto parts that we avoided this one properly. Maybe Stanley Black & Decker. Wait, what is it? I know it's a weird ticker. Morgan Stanley SWK. So again, same thing, only 2 years worth, right? So we've managed to avoid that one because it was super overvalued. And by the time it was reasonably valued, there was reason for it to be, so it wasn't quite as tricky. So this isn't the only one. I mean, Target might be one too. I'm not sure. Target, 56 decline. This one was predictable, I think. So, and I think I actually probably warned people about that one. So, but Tyson snuck by me, and I think this is the reason why. The change that I made, which I sold a bunch of stocks on the day that I sold this one, which was May 8th of last year. And the reason I did it is because we entered a new, what is now and could longer term be a new interest rate environment that's more normal than like what it had been at 0%, right? So during the time, last however many years, at least 5 years, maybe longer, probably really going back to 2015. I mean, I haven't taken interest rates into account. I have a baseline inflation expectation of like 3% that I just kind of build into everything no matter what, so I'm not trying to predict interest rates. But when it comes to like valuations, one thing that I just ignored because interest rates were always so low was debt, right? And different obligations along those lines. And I had ignored those forever, basically. Well, not forever, but since 2015 at least, when I started writing and analyzing stocks, because it just wasn't a big factor. Like it wasn't moving stocks unless it was horrible, right? And that's where I went wrong with Tyson. And by May of 2023, I recognized that and I made adjustments for it. So now I make adjustments for debt and things like that to the valuation. Once I did that, some of these valuations that looked good no longer looked as good. And so if we look, and so the way that I do it this quickly is I just look at the total enterprise value, okay? So this is preferred stock plus debt plus minority interest. I mean, you can see it there. I look at what that value is compared to the market cap, and then I basically see how much of a percentage higher this is than the market cap, and I adjust the stock price accordingly based on that. So it really punishes stocks, businesses that have more debt and obligations of those sorts. And Tyson was one of those. And so what I did was, I can't remember, it was during this drop, but it was just a coincidence actually that I sold it on the 8th, it said. So I don't know if what day of the week it was, if I ticked this little bottom here. I don't remember exactly how that worked out because this doesn't have daily, it just has kind of weekly. But that drop there was basically irrelevant because I sold a whole bunch of other stocks based on that metric on the same day, because I just made that adjustment. Those ones did not, they looked overvalued then, and so I sold them. And so now let's look and see kind of how that affects the valuation of Tyson now that I made that adjustment, okay? Let's see. Okay, so I still track Tyson, and there are a couple of different ways. This is going to get a little bit tricky because of this giant earnings drop. So really what I want to know is, buying now, are these earnings going to recover? So you can see analysts expect them to start recovering. And what I really want to know is, okay, well, if they recover in a couple of years, what does the valuation look like then? Because we don't want to base it on this super duper. So if we thought the 37 PE was going to stay forever, then that obviously would be a bad deal. But you can see the analysts expect earnings to grow 44%, 73%. So they're expected to go from, we'll call it a dollar, to grow by 3 times basically in the next 3 years. So, I think that's right. Yeah, 260. Yeah, up to 4. Yeah, about 3 times. So that's way super fast growth, but you don't want to extrapolate out that kind of growth. So what I do is I measure from this peak earnings down, and compare that to like these past declines. So I probably went back and maybe used a decline back in here from this peak to try to estimate it, or I might have used this one. I forget exactly how I did it. But the theory is you use that peak PE as a baseline and how far the stock has fallen this time on one of these downturns compared to like a past one, which would have been back here. And I can look, and it gives you a stable point to aim for so that these wonky earnings changes don't completely screw up your valuation. You really only want to do this on pretty high quality businesses you think are going to eventually come back. Now, Tyson's cutting back costs. They're closing down plants. They're doing some of the things that they need to do. We'll probably have we've had a lot of immigration this year. That might relieve some cost pressures on labor. There's all kinds of other things that they'll probably do over time to drag these earnings back up. But who really knows? Nobody knows the pace. Nobody knows anything. So it's good to have this stable point to go from so you can ignore all this and then just try to find a good estimate. So that's what I do here. And when you do this and earnings are way, way down, then your recession PE, your recession buy price is actually higher than the normal buy price, which is what happens here. So the recession PE gives you a more rational view when things are horrible, of like a $25 buy price, than if you actually use these super low earnings that are at now, combined with a 10% growth rate, which is what they had previously, not the 100% growth analysts are expecting. And then you would need a much more. So this is probably too negative. So when a decline first starts, the recession PE looks really negative until it overshoots, like Tyson probably has done or will do. And then your recession PE looks more reasonable because it's just more stable. That's the idea behind it. But the main thing I want to point out here is when you adjust for the debt, that's where the big change comes. So this is the normal price. When I adjust it for the debt, which is, I don't know, the last time I did this, like 50% more. So it's more like an $83 stock price, which is more like a 28 PE based on the peak earnings up here. I believe that's how I did it. I don't remember for sure, but it's probably. So it just gives you a much more stable number to work with. Actually, I don't know if this PE doesn't have, I don't know if it actually has the debt built in, but I know the earnings yield does. It depends on how I built the spreadsheet. It's been a while since I actually did it. but it should come through in the earnings yield, which is only 2.31. So if you think, yeah, that's like a 20. Yeah, so I don't think this actually has the debt, but the earnings yield does. I think that makes sense. So yeah, you would only be earning $2.31 on your, if you include debt, on your $100 investment. So that's why the even though it might look cheap using the peak earnings, which is what I'm doing, in reality, the CAGR comes out really low. So this is probably too low. Like this is probably too negative. It gets really hard when you try to do an earnings analysis on it when earnings are just going crazy, basically. So it's really anyone's guess kind of what happens here. But if it fell 50%, I might be a buyer at that point, because there's only so many people, only so many businesses that process food as much, in the country. So it's I don't know if I would totally call it like an oligopoly, but I mean, there probably is a limit to the downside bottom as long as management doesn't completely screw things up, and they probably won't over time. So yeah, if it fell another 50%, I might be enticed to buy it again, but I definitely will be taking the debt into account, because the market is. That's why they traded down to a 9 PE and why they were cheap here. This is even before COVID, even back here, again, we see the same thing. So the market is including that, and probably investors should too in some way. This is my quick way of doing it, so I don't have to, because I follow a lot of stocks, and I just want to get roughly correct, and then I know if I place enough bets, then every now and then when something deep work might have uncovered comes up and I miss it, then that's okay, because some other times I'll get lucky. So if you can generally kind of have enough factors that have a confluence together, you can avoid the worst and sometimes capture the best over time. All right, so that's my thoughts on Tyson. I would aim maybe 50% lower before buying if you're looking for good returns and a margin of safety. I mean, if you're not, you're looking at, yeah. It's hard. It would have to be at least like 20-25% cheaper before I think it even kind of looks fair value. It looks a little overvalued still to me. All right, if you enjoyed this video, hit the subscribe button, hit the like button, and if you have a request, drop it down in the comment section, and I'll see everybody later. Bye.